And thank you so much for tuning in as always. Today, what we're going to be talking about and shedding light on is going to be the China-related funds, ETF funds, especially at a time when Indian markets are witnessing volatile moves. Is it time to actually start exploring these Hong Kong, China-related funds, given that they have been underperforming for a while? So do we start looking at that, given that China's growth is expected to come back? And could investors actually start benefiting from this? What are the risks that are related to this? And to discuss more about this topic, we're joined by Tarun Birani, founder and CEO at TBNG Capital Advisors this afternoon. Tarun, good afternoon. Thank you so much for joining in with us on the show. And, let's start by talking about this topic, right? What we're seeing is in the recent times, there's strong performance that has come in maybe from the Hang Seng ETFs. And should Indian mutual fund investors consider diversifying now maybe to these China-related funds? International funds, yes, we've spoken about. But specifically China-related funds, is it time to start looking at that? And what is the potential benefit from these funds right now?
So, good afternoon, Vinny, and thank you for having me in the show. Let me just try first give you some data points on China, and because I think we are talking specifically about Chinese market. So, Chinese GDP is approximately like $17.5 trillion as we speak, compared to $4.5 trillion India's GDP. And this country is growing. China is growing at roughly 4.5-5% annual compared to 6.5-7% India is growing. The per capita income in China is approximately around $12,500 compared to very low levels in India, right? And it is the per capita income is growing at 11.8% CAGR kind of thing. Talking about from a diversification point, your specific question, I strongly believe that one need to have a diversified portfolio. One need to have portfolio geographical diversification is also one very, very important part of diversification investors can look at. But if I look at specifically towards Chinese market, last 25 years have been a watershed moment for Chinese capital markets. The equity index return, Hang Seng index return from last 25 years is absolutely zero. No returns have been generated. The current stock valuation, and again, as a analyst, I will always look at 3-4 important point is the valuation, and current valuations are roughly around 13-14 times compared to average emerging market valuation of 20 to 25 times. Again, one very important parameter like dividend yields are higher than the bond yields trading in China. So all these makes I would say from a long-term investor point of view, and again as a contrarian investor, Chinese market looks good to me from a long-term investment point of view.
Okay, long-term investment point of view, it looks good to you. What are the risks that are there for this as well? When an investor is looking, what are the risks that they should be aware about? Given that the current market scenario and everything, what should one really look at before they actually look into investing into Hang Seng ETFs or China-related mutual funds?
So again, if you look at last 1 year, we have seen a good amount of recovery happening in the Chinese market. And this has been actually driven mostly by a policy-driven recovery, where there are a lot of actions which the government has taken, which is actually like regulatory crackdown, real estate distress, and again, global trade tensions. All these are some of the reasons due to which we have seen there is some bit of interest developed for Chinese market. Again, there has been a lot of pro-growth measures, rate cut, infrastructure stimulus, as well as AI and semiconductor investments have boosted the sentiments, and which made the medium-term outlook very attractive. But again, from an environment point of view, the key risk investor need to be aware is last 25 years why returns have not been great, and it has not been like the darling of investors is because of the big reason is regulatory concerns. We have seen companies like Alibaba, where the promoters, I think the returns in these companies have been practically zero because one day regulatory action by government has taken away all the returns of these companies. So that is one of the large reason, I would say, regulatory volatility. Second is the geopolitical concern. One need to be aware that one big risk currently, every day we are hearing US-China tension, trades tension, and with Trump coming on board, every day we are hearing some or the other trade tension coming in, right? So that is also one very large risk investor need to be aware. Currency risk is also something. Chinese yuan depreciating against INR or USD could impact the INR returns. And again, tech dependence on AI and semiconductor, which we know US export bans on AI chips can happen and all those things. So these are some of the risk investors need to be aware before investing. Yeah.
Absolutely, Tarun. I'm going to pick up a few points from what you were talking, right? You just talked about tech, AI, and those are the points, that is, in the recent times for China has actually become one of those factors which has led to the growth or, the excitement that is built around that. For an Indian mutual fund investor, a strategy that they should follow, should it be, more of those sector specific that one should look at? And are there available options for an Indian investors to look at those options? Also, broader market ETFs, which is a better option for them right now?
I strongly believe China is more of a consumption driven market, and with $12,500 per capita income, I think we are seeing once a country reach this kind of growth in per capita, the pattern changes in consumption where more luxury, premiumization, all these things start happening there. So I feel from a China point of view, consumption looks like one of the best story to me, and anybody who can participate in Chinese consumption. And let me give you one example. Let's say the price to earning of a consumer stock like a Samsonite in India is trading anywhere between, or let's say take example of a company like Blue Star. Blue Star in India, which is like an air conditioning company, is trading at 36, 37 times. A similar electronic company or an air conditioning company in China is trading at 13, 14 times right now. So which again is like a huge divergence from a valuation point of view. So somebody looking at core consumption, I feel that is one of the most attractive things. AI and semiconductor, yes, China has taken a lot of leadership with this DeepSeek thing coming in. I think it has really shown that how they can produce at a very low cost, right, compared to companies like Nvidia. But again, I see the regulatory part and the restriction part, US, China issues can have impact on that. So rather than tech part, I would be more bullish on the consumption side. Okay. Consumption side looks more stronger, but one can participate in through a diversified fund rather than getting into specific themes like this.
Absolutely.
To reduce the risk.
Absolutely. To reduce the risk is better to go in for a diversified fund instead of, picking out a theme and going for it. And even if it's a theme, you still think that consumption is a better play in China than a tech side fund would be. But, Tarun, let's talk about allocating the money, right? Like, how much of the international mutual funds, if you are investing in, how much should be allocated maybe to these China-related funds? And what is the proportion that you would be allocating here?
So if you ask me, say around, it's always good to have 10 to 15% portfolio outside India. I think your home country bias can be reduced dramatically. Being US being the largest market, I think most of the international money has moved into US. But I feel since US markets have also been rallying for such long time, valuations have been so high, it would be good to start with anywhere between 2.5% to 5% allocation into markets like this. That could be a good strategy to start with.
Okay, so I'm sorry, what is the percent did you say for this? Is 2.5 to?
So anywhere between 2.5% to 5%. But again, I feel 2-3 important points one need to be aware. Not to invest at one go. Use staggered entry strategy, not to enter at one go, so that you can have a rupee cost averaging strategy, as well as keep monitoring the policy risk, because the biggest risk is the policy risk. Tomorrow, if there is any change in the policy, it can really change the things. But I feel consumption as a theme will be a more structural theme. So there I don't see much policy issues coming in. But other places, I think there could be policy risk coming in.
Okay. And are there any, one though I want to know, is there any consumption side of China-related fund that, you are looking at or that is looking nice right now or an investor could look at? And, given that if someone is coming new into this segment or investing new into the international fund, specifically China-related fund, are there any special points that they should be keeping an eye out on or factors that they should be keeping an eye out on?
So, as you are aware, there are restrictions. So, there are two ways to invest into international market, right? The A is the fund of fund routes. A lot of Indian mutual fund offer investing into outside funds, right? US funds, Chinese funds, through the feeder fund route. But due to RBI restrictions and limit which has been put for the foreign investments, I think most of the funds, Indian funds. Feeder funds are not able to invest. No, they are not taking any fresh subscription. But there are some funds where the limits are available, due to which I think one can participate. So one route is to invest through all these funds available. Another route is there are some ETFs, indexes like a Hang Seng index ETF is available in the market. Through the secondary market, one can participate in these ETFs. That is another route. And the fund of fund route through the feeder fund route, which is available, one can participate in that. Other route is one can look at investing through the LRS route, where you can invest money in dollars, and through that you can participate and pick up all these ETFs, Chinese ETF, which basically participate in the Chinese market. There you have option to pick up consumption ETFs also, tech ETFs also, and the diversified Chinese market ETFs also are available.
Okay. And Tarun, are there any concerns in terms of liquidity, expense ratio when you invest in such funds, or in terms of taxation and all? How does that work when you're investing in such a fund?
Right. So taxation has been made fairly simple now, and all fund of fund global funds have a taxation. If you keep investment for more than 2 years, there is a 12.5% tax on that. And apart from that, if you go through a LRS route, also similar kind of tax structure is available. So that is, according to me, is the best one. And best taxation available right now because of the policy alignment. From an expense ratio point of view, I feel the ETFs, index funds will be the cheapest compared to fund of fund route. So investor can invest in them based on the same. Yeah. Plus liquidity point of view, yes, you need to be mindful. If you invest through a ETF, you need to see the liquidity available and the impact cost, which will be there due to the buy sell spreads available in that.
And are there any expense ratios or anything which is higher, or how does that work here?
So ETF expense ratios will be lower, but the fund of fund, because the Indian fund will also charge and the global fund will also charge, so the expense ratios will be higher in the same.
Okay. Okay, Tarun, thank you so much for giving us that update on the Hang Seng related funds or China related international mutual funds. If you're looking to invest over there, viewers, this will be helpful for you all. But on that note, we're going to slip into a very short break. On the other side of the break, we're going to talk about investing in direct stocks versus investing in mutual funds, and what has given better returns and what should you be choosing. Stay tuned for that conversation. Welcome back. Thanks for staying tuned into Mutual Fund Corner on CNBC TV18. Now let's continue the conversation and actually talk about investing directly in stocks versus mutual fund investments. What is a better option for you? And why are we saying that retail investors actually lose money in direct stocks most of the time? To talk to us about all of this, we're going to carry forward this conversation with Tarun, who's here with us. Tarun, this is such a common phenomena that we've seen, right? Because when you're directly investing in stocks, there are investors who make more losses in this fund versus obviously managed funds or PMSs, index funds. Main criteria or mistakes that people make while doing this, and why should they be preferring mutual funds over this?
Great. So I will start with a lighter note. So what I'm observing is, if there are two brothers in the family, one brother is managing the factory, other brother is managing investment, or he's a full-time trader in the equity market. So this is a pattern which this bull market in last 3-5 years has resulted in many so-called traders or investors have been born. And I think, which I feel is somehow not going in the right track, because I am a strong believer of that camp that trading can never make you money. And if you see the NSE data also, where 90% of the traders lose money, that is one data which has been very clearly validated. Again, let me give you some very important numbers. As we talk from 26 September, we have seen the Indian markets have started falling or correcting, where the broader indexes are down anywhere between 13 to 15% in this time. We have seen almost like 66% of the BSE 500 stocks are down more than 30-35%. That is the average number of fall in these stocks. And I have seen last year was a year where most of the new IPO, and we have seen almost like 300 plus offers for sale and all these schemes in the market, where almost like most of the promoters have sold in the market. These newly listed stocks are down anywhere around, that index is down almost 37% from the peak level. So you can see the kind of fall or the correction we have seen is very high compared to, if you look at normal funds, diversified funds, it has been much lower. Indexes, it has been much lower. What I'm observing is one of the big reasons for this thing is survivorship bias. And there is a very important behavioral bias called survivorship bias, where if you see in every last 3-5 years, the top 50 stocks or top 30 stocks in the markets keep changing. The rotation of the leaders keep changing in the market. So like Reliance and Infosys survived, but what about stocks like Yes Bank, DHFL or Anil Ambani group companies, right? These stocks have gone out. But what we have seen is investor ability or skill to change this in their portfolio is very low, because I think the domain expertise is lacking, because it is a full-time work according to me. So, and again, the decision like portfolio sizing. So let's say if you have 15 stocks in your portfolio, how much you should have? Let's say 5% of your portfolio in stock A versus 7% into stock B, or the concentration level. I think as a professional fund manager, I see there are a lot of tools available. There is a lot of structure which is available to ensure the portfolio is diversified, and this survivorship bias risk is taken away. Again, benchmarking against the index helps them to keep rotating portfolio. But again, one of the very important reason investors lose out in direct equity more compared to managed fund is the behavioral bias, right? Based on a Dalbert study, which is like the leading research agency, investors have lost almost like 3 to 5% more compared to index investing because of the poor timing. Most of the investors invest at the peak of the market and they sell at the lowest level of the market. And we have seen this time and again happening. And I think as we talk today, most of the investors who are out of the money in the stock, they're selling their stock. Again, there are time and time and research constraint for direct equity investor. I think they have become investor based on some friend telling them they picked up in their portfolio, but nobody has researched that. So all these things are very large reasons where we have seen the returns are not appropriate. Again, there is no goal-based investing mechanism in this. So I feel this is a big sign that I can take a full day workshop on this, if you ask me.
Yeah, absolutely. But when you're investing, some of the concerns that I hear also from direct investors into the stock market is that the fees on that concern, whether they're going to be paying higher fees from the mutual fund side or a PMS side versus on the direct side. Is that something, and how could one be addressing that concern? Is this just a myth?
So I just feel one need to be aware of a very strong concept called MVOT, money value of your time, right? So the time you will be investing in managing your own fund versus someone else managing your fund, one need to be aware, right? Let's say if I make X amount of money as an income every year, if I invest more time in upgrading myself, I will make more money in that, right? So investing, if you are spending say 10 hours, 15 hours in a month, I think that according to me is an opportunity loss, right? I think if you look at somebody professionally managing and he would be charging, let's say 1%, 1.5% to manage the same, I feel that is worth the time compared to something which you can't manage because you are getting a professional expertise, somebody who is helping you in stock selection, the mistakes which you would be making, diversification in your portfolio. Again, higher risk adjusted return. We have seen most of the funds have delivered a better than index return. And if you feel the cost is high, you can pick up indexes also. Indexes are available at much cheaper rate compared to the active funds. But I feel managing yourself, if you don't have the know-how or domain expertise, it's not going anywhere. That is what I am observing.
Absolutely. Thank you so much for that, Tarun. Tarun, actually, we will have to take one of those full day sessions with you on this topic, but we are out of time on this edition of Mutual Fund Corner. So thank you so much for joining in with us and giving us a bit of an insight on this one as well. It's a pleasure having you in the show. And with that, we're absolutely out of time. So thank you so much for tuning in. Up next, we have Closing Bell.